Please be seated. Ray, thank you for that glowing introduction. I thank you for your help here at the Bush Center. You and the board members who are here, I appreciate you being here. I want to thank Margaret Spellings for her leadership and your team for putting on a fabulous conference. We're trying to advance the notion that our economy can grow better, and one way to do so is to educate people about how all aspects of the levers work. And I've been fascinated by the discussion, and I want to thank the panelists for lending their expertise, particularly the Reserve Bank presidents, Richard Fisher and John Williams, and my friend Augustine Carstens from Banco de Mexico. So thank you all for being here. We've had two moderators, one cute and smart, and the other one was Al Hubbard. I want to thank Maria for coming as well, and you too, Hubbard. One of the great joys of the White House is working with incredibly good people, some of whom are here. I really don't miss Washington, but I miss working with smart, capable people who care a lot about the country. And it's great to see you all, and thank you all for coming down. I want to thank our sponsors for this event and our donors. Hopefully by coming here, for those of you who haven't spent much time here, you get a sense for the difference this center is making in our nation's life. We're doing a lot of interesting things. This conference is one of the more interesting we've done. We're about to have an interesting conversation, speaking about interesting things, with Josh Bolten and Ben Bernanke. Josh was my chief of staff. Josh is one funny guy. Josh is one smart guy. People often kind of look at you when you talk about your White House years with a sense of dread. They say, oh man, it must have been miserable. It wasn't. It was exciting, stimulating, and joyful. And one reason there was so much joy is because we had a great leader as Chief of Staff in Josh Bolten. He will be interviewing Ben Bernanke. Bernanke, I came to trust Bernanke. I got to know him in the White House. He was an economic advisor. You know, these economic advisors are important. Like if they had three hands, they would say, you know, how's the economy go on the one hand, on the other hand, and the third hand? Bernanke wasn't exactly from the political class that was my strongest support. That would be your professors. But I learned to trust his judgment. One of the key ingredients for being an able leader, I think, is to recognize what you don't know and be willing to admit it, and find people who do know what you don't know and listen to them. I'm in the Roosevelt room, and Bernanke says to me, and others in this audience were there, and he says, you better do something, otherwise we could be headed for a Great Depression. Pretty sobering words for a president to hear. And so the first thought that should cross anybody's mind is, do you trust the person saying that we could be headed for a Great Depression? Before you decide whether or not you want to risk the Great Depression, is the judgment of the person issuing those words worthy of listening to? And in Ben Bernanke's case, they were worthy of listening to. He's a sound thinker. Curiously enough, had written a paper on the Great Depression. He writes a paper on the Depression. Years later, he's saying to a president, you better do something because we could be confronted by one. I not only appreciated his sound advice, but I got to watch him under fire. He and Paulson made an unlikely team, but as a team that handled pressure extraordinarily well. There's a lot of pressure on the economy in those days. I'm sure you remember. It's like the guy walks in and says to me, are you aware of how bad the TED spread is? And I said, I don't even know what the TED spread is. I'm going to ask Bernanke. They handled it. He was cool under fire. I consider both Josh and Ben Bernanke friends. Please welcome to the stage two fine Americans.
Thank you, Mr. President. You have a nice place here. Thank you for inviting me.
And for having me back, Mr. President. Thank you very much. It is a privilege to be here. And let me say my thanks to the organizers of this event and the folks that run this great institution, Mr. President, and the way you've handled your post-presidency, which makes us all proud. Ben, the President took us exactly where I wanted to go, which is the meeting in the Roosevelt Room, when you and Secretary Paulson came to ask the President for authority to go to Congress and ask for nearly $1 trillion in appropriated money to save the people that caused the crisis. That was a
easy sell.
Yeah. That was a difficult session. Tell us about it, a little bit about it from your perspective, and then say a little bit about the importance of the relationship between the Fed chairman and the president.
Sure. Well, this was just a few days after Lehman weekend, as it's come to be known, middle of September of 2008. And it was clear that the panic was getting out of control. You know, we tried desperately to try to save Lehman. We didn't have the tools to do it. It failed. Its failure led to a freezing up of the money markets, the commercial paper market after the reserve fund broke the buck. We desperately worked to save AIG, which we did, but even in doing that, of course, it was a huge shock to the markets. And what we had was a classic financial panic. In fact, this was the kind of thing that the Fed was created to deal with. I mean, 1907 financial panic. Except we were here talking about a globalized economy, enormous firms, globalized firms, and I thought we were at tremendous risk. I really had some very, very black moments that week. The thing that struck me as we were sitting there on Lehman weekend, as I was talking to Hank Paulson, you know, and he and Geithner were at the New York Fed, and they were talking to the Wall Street guys and trying to figure out a solution, my reaction was, you know, we've been trying to deal with this on an ad hoc basis. We've been trying to use whatever powers we could find to stop the panic, stop the crisis. This is beyond what we can do now. We have to go to Congress. We have to get a big supporting program to help us attack this thing once and for all. And I was persuaded that we had to do that. And a couple days later, Hank and I went to the Roosevelt Room. I believe you were there as well.
I was.
And we told the president that we'd just taken over the world's largest insurance company, and that we were afraid that other major financial firms were on the brink and that our whole financial system was on the brink, and that we needed to take strong action. It was only $700 billion, Josh. Let's not exaggerate. It wasn't $1 trillion. We did need to take very strong action, and we needed for the Congress to step up and to do this. And we needed, of course, the president's support. And I very much appreciated, the president was very modest about, you know, listening to people who know about these TED spreads and things like that. And I think he knows a few things about financial markets, but he was extremely willing to listen to me and Hank and to take some steps, which I know were deeply uncomfortable for him to take, to go on television and tell the American public why we were going to have to, quote, bail out some of these large financial firms. But it was absolutely essential to do that. It was the beginning of a process whereby a few months later, by the spring of 2009, we had stabilized the system, and we were on the way to bringing the economy back to more normal conditions. But it's really hard now to remember how black the situation was in October of 2008. And again, the president played it just right. He was very respectful of the independence of the Fed. He always gave the appropriate space. He took responsibility, but he was also willing to listen to those of us who were trying to explain our perspective. And he agreed to support us, and it was critical. And we got it done. It took a little while, but we did get the bill through Congress, and it was the beginning of the process of stabilizing the system.
I don't want to dwell too much on the crisis or the lead up to it, but let me ask you just one question about that, and that is that before the real dark blackness hit, there were signs. When you became Fed chairman in 2006, house prices were already falling. In 2007, signs of serious problems in the subprime market were evident, evident at least to the financial community. Why did the Fed and other policymakers not see the makings of the huge crisis earlier than they did?
Well, remember, I mean, one way to think about it is that, we just had the tech bubble, and that had popped. And what followed was a relatively moderate recession. The 2000 didn't seem all that moderate at the time, but in retrospect, it was a pretty moderate recession. And here we had a decline in house prices that looked to be slowing housing activity, slowing consumer spending, was taking about a percentage point a quarter off of growth. So it was having a definite negative effect. But the question was, wouldn't the decline in house prices have an effect similar to the decline in stock prices that we saw in 2000? Because they were about the same magnitude. Now, there's some differences, of course. Houses are owned by middle-income people, and they may respond more strongly to changes in house prices and so on. But there wasn't much reason at that point to think that the crisis was going to be so much more severe. Now, what was missing in our thinking, quite frankly, was what was different between the tech bubble and the house bubble was that the stocks were held essentially in an unlevered way. That is, people owned stocks, but they weren't leveraged to the hilt to own them, nor were major financial institutions leveraged to the hilt to own them. So it wasn't so much the decline in house prices or the decline in stock prices, it was the impact of that on the stability of the financial system. And we asked, as supervisors, we asked the banks as late as 2008, we said, if house prices fall 20%, what will that do to your balance sheet? How will that affect your capital? And they all came back and said, well, pretty modest, wouldn't be a big deal. And frankly, I think if there were many failings, and I certainly agree that there were regulatory failings, but one of the failings of regulators was we didn't make the banks early on develop the IT systems, the management systems, that they could really assess accurately the effects on their balance sheets of something like a decline in house prices, a big decline in house prices. And the stress tests, the things that we do now, I can't use the word we anymore, the Federal Reserve does now, are really a big part of that is this risk management exercise, which gets banks to assess what would happen to their capital and their liquidity if they were hit by a huge recession, big decline in stock prices, et cetera, et cetera. So what was missing in 2007 was not an appreciation. I mean, we certainly saw house prices were falling. We certainly saw that house prices could fall 20 or 30%. That was certainly a possibility. It was talked about as early as 2005 at the FOMC. But what we didn't see, or at least we didn't fully appreciate, was the extent to which declining house prices would create so many losses in the mortgage market and related real estate assets that it would bring the major financial firms close to the brink of failure. And that was the difference. And when that happened, then we had to respond through the TARP, through the Fed's liquidity programs, et cetera.
Well, and in fact, major firms were very close to the brink of failure. Some of them did fail. First, Fannie and Freddie went down. Then Lehman went down. Then AIG almost went down.
Right.
Why did the Fed and Treasury save AIG but not Lehman's?
Well, the retrospective history on this has really gotten inverted. So what people will talk about it now, they say, well, it was obvious they should have saved Lehman, and they decided not to. The truth is exactly the opposite. The truth is that, at least at the time, the conventional wisdom from everybody, from the Wall Street Journal to the New York Times, was the system is ready, let Lehman fail. Henry Paulson should take the weekend off. That was the Financial Times headline. So there was a very strong view at that time that the government should not intervene with Lehman. We had a very opposite view. We believed that, notwithstanding the legitimate issues of moral hazard and so on, that the collapse of a major financial firm in the middle of what was a building panic would create a level of crisis that would have huge negative effects on the economy. And we tried desperately hard to find a way to solve the Lehman issue. The difference between Lehman and AIG had to do with the nature of the two companies. So how had we worked before? So with Bear Stearns, we had an acquirer. With Fannie and Freddie, we had government money approved by Congress to put into the company, take them into conservatorship.
Take over, basically.
Yeah. With Lehman, we didn't have an acquirer. We went into the weekend with both Barclays and Bank of America supposedly interested, but for various reasons, both of them dropped out, so we had no acquirer. And the reason they dropped out, and we had many private sector analysts evaluating that balance sheet, the reason they dropped out was they said there's a $40 or $50 billion hole in this balance sheet, and unless the government fills that hole, we're not interested in this company, or more. The problem was the Fed could lend. The Fed could lend against collateral. The Fed did not have capital. The Fed could not put money into a company and create capital. That was something that the TARP was able to do later. But at that time, the TARP, of course, had not existed.
And is that the difference between Lehman and AIG?
And AIG lost money and got into trouble because it had this financial products division in the holding company that was essentially a hedge fund and had lost a huge amount of money betting that house prices would never fall. So they lost a ton of money. But the difference between Lehman and AIG was that underneath the holding company, there was a huge insurance company with multiple subsidiaries around the world, which had real value. And therefore, there was collateral. We judged that what was going on with AIG was that they were being hit by a collateral call, that they were being forced to disgorge large amounts of cash. So the question is, can the Fed lend to them so they can meet their cash requirements? The answer is only if they have collateral. And our judgment was that even though they didn't have enough collateral of the sort of usual securities forms, that the value of the entire company was sufficient to cover the loan. And that's the basis on which we made the loan. And by the way, again, going back to this issue of moral hazard, of course, we put very tough terms on AIG. Stockholders, lost most of their wealth. Management got replaced, et cetera. But again, we really felt at that point, particularly following after Lehman, that the collapse of AIG would be just fatal. But again, there was a very fundamental difference. It wasn't a change in strategy or change in philosophy. It was a change in the circumstances. Lehman did not have the collateral. It was insolvent. It was coming apart at the seams because people were leaving, customers were leaving, counterparties were leaving. There was no value there, nothing to lend against. AIG had the subs that we could lend, and that's what we chose to do.
And that sort of temporarily stopped the bleeding. Then eventually, when the TARP got through, that helped a great deal. And then take us to the immediate aftermath of the crisis. You led the Fed into truly uncharted territory, stuff that the Fed had really never done before. And you started quantitative easing. Tell us, first of all, explain in your words what quantitative easing is, 1, 2, and 3.
Sure.
And why you did it.
Sure. Let me just say that there were, TARP in October, it was still maybe March by the time the system was stabilized.
Right.
And one of the key things that ended the crisis was the stress test that the Fed and the Treasury did, where we evaluated each bank and had them publish the results and restored confidence in the banking system. That turned out to be a really important step. So by March of '09, there was still an awful lot of stress in the financial system, but the crisis was beginning to calm. Now, what the issue we faced was double. First, the Fed had already cut interest rates. The usual response to both a financial crisis and to a recession is to cut interest rates, ease monetary conditions. The Fed had already cut interest rates as of December, the previous December, to 0. And once you get to 0, obviously you can't cut interest rates anymore. But it still could be a situation where you need to do more to help the economy, and we felt that that was such a situation. In fact, interestingly, when I became a governor, when President Bush appointed me to the Board of Governors in 2002, the second speech that I wrote and presented was one exactly, what happens when you get to zero? And I talked about some of the options. And while people say these were all unprecedented, et cetera, that's not really quite true. Many of these ideas have been talked about before, been talked about by Milton Friedman, for example. They've been used in Japan. And the basic idea, though, was very straightforward. The idea was, look, we can't lower short-term interest rates anymore. We can't lower the overnight, very short-term interest rate. But we can try to lower longer-term interest rates. And how would we do that? Well, one way to do that was to take money and go out and buy longer-term Treasury securities on the open market. And in buying those securities and putting them on the Fed's balance sheet, we were able to bring down somewhat longer-term interest rates and provide additional monetary support for the recovery. So the biggest action, so-called QE1, was in March of '09, and I think it really accomplished two things. One was it helped the economy begin to recover from the deep recession, and I don't think it's an accident that the day QE1 was announced was the day that the stock market hit its absolute bottom, and after that, it began to rise as the economy began to improve. At the same time, at that point, financial markets were still quite stressed. There was a lot of reluctance to trade. Liquidity was poor. So by putting money into the markets, that also helped improve market functioning. So it was a two-for-one in that respect. And I think that was a very effective program.
So from your standpoint, it's all worked?
Well, let me react to a couple of things that were said earlier today. So one kind of thing people say is, well, first of all, the economy has recovered. We've seen 5 years of growth, but it hasn't been as fast as in other recoveries. Therefore, monetary policy must have failed. There's a non sequitur there. There could be other things going on, and there certainly were. In particular, as other people have noted, there were policies from other parts of the government that were working in the opposite direction. And in particular, in the last couple of years, fiscal policy has been a very significant drain. On top of that, there's a lot of evidence that financial crises tend to be followed by slow recoveries because it takes a while for the financial system and the credit system to get back to more normal conditions. On top of that, we also had, of course, the housing bust. And so the housing industry, which is normally a big part of any recovery, was moribund. So there were a lot of headwinds, a lot of reasons to think that the recovery would be slow. And the people who have looked at this, and there's been huge amount of academic work done on this, trying to assess the effects on markets and on the economy of QE, is that yes, it wasn't a panacea, obviously, but it was helpful. It did provide some additional support. And in particular, as John Williams mentioned, we avoided deflation, and that was not a small accomplishment.
Well, this morning, Mark Okada, I think, voiced concerns of a lot of folks in the capital markets who were very nervous particularly about QE3 and how that is likely to be unwound. What can you say to Mark to make him less nervous?
Well, again, the purpose of additional rounds, again, acknowledging that the Fed and monetary policy are not a panacea, that the Fed can't solve all these problems. There's many other serious problems in our economy that can be addressed only by other policymakers. That doesn't mean the Fed shouldn't do what it can, and that's what the Fed has tried to do. And the QE3 seemed like an important step, given that at the time that it was undertaken, the economy was faltering again. It was weakening, and prices were again slowing down. So there's a bit of a tendency to say, well, why did the Fed do all these crazy things? Well, the economy's growing just fine. Well, how do you know it would have grown if the Fed hadn't done these things? And I think that, again, that taking these steps has been important in helping the economy recover as much as it has, and it has made meaningful progress. But I think what I would say to him is that, again, what's happening here is essentially normal monetary policy, except that money is being traded for longer-term bonds instead of for shorter-term bonds. That's really all that's happening. Another way to look at it is that the government's financing is being moved from longer-term financing to shorter-term financing. It's not if you think about it from an economic point of view, it's not all that radical. To talk about it from the point of view of an investor, I think the main thing to explain, and I think John also talked about this, is that the Fed has worked very carefully to figure out how to raise rates at the appropriate time. That will eventually happen. We hope it happens because it means the economy is coming back to normal. Whenever the Fed raises rates at the end of a recovery, there's very frequently some bumpiness. There was, for example, in 1994, well before any of this stuff was happening, when the Fed indicated it might raise rates, and there was a very big movement in the bond market as bonds overreacted to the Fed statements. So that can happen. So you can have some bumpiness as the process of tightening begins, which again ultimately has to happen. But in that, otherwise, it'll be a fairly normal process because the Fed does have appropriate tools to raise interest rates, even if the balance sheet doesn't drop a dime. So let me be very clear, there's absolutely no need or requirement for the balance sheet to go back to normal as monetary policy is normalized. The balance sheet could be kept where it is for a very long time if necessary. Other central banks around the world have balance sheets as big or bigger than the Fed's relative to their economies, and it doesn't cause any problems. So the main thing is that interest rates can rise at the appropriate time. That will slow that will reduce the amount of monetary accommodation, and that will allow the economy to go back to a normal growth path with, we hope, 2% inflation. And again, there's no reason to think that that's not going to be fairly normal in terms of the kinds of exits that we've seen in the past.
Well, we're going to get to Q's and A's from the audience in just a minute, and maybe Mark will want to maybe come to the microphone and let us know whether you've been calmed by Chairman Bernanke's answer. Okay, well, we already know that Mark feels better, so I'm happy to report that. Just a couple of quick questions before we get to audience Q&A. There was discussion in several of the panels this morning about the distributional effects of some of the remedies that you and your colleagues have applied, with even the suggestion that the monetary policy fixes for the crisis have exacerbated inequality in our economy. What's your perspective on that?
Well, I think it's not completely untrue, but I think it's a little bit exaggerated. First of all, of course, the Fed has to use whatever tools it has, and the tools that the Fed has are interest rate financial market tools. That's all it's got. So if it's going to meet its mandate of trying to stabilize inflation and support recovery, then it's got to use the tools it has. And of course, as I said, those tools work through asset prices. Now that being said, if you think about it, there's on the wealth side, it's true that lower interest rates have helped stock prices go up. It's been one of the reasons the stock prices have gone up. But the reason the stock prices are up, there are two reasons. One is, of course, that the economy is looking better, and that's a good reason. That's obviously a good reason for stock prices to go up. The other reason is that returns are lower. And I think it's kind of funny that people say, well, you're making rich people richer, but of course you're hurting savers because rates are so low. Those two things are contradictory. The reason stock prices are higher, in part, is because returns are low. And so prices are high when returns are low. That's just the logic of financial markets. So anyway, so there is a stock market effect, and part of it comes from a stronger economy, part of it comes from the reduction in returns, which is, by the way, a global phenomenon, of course, at this point. So to the extent that stock prices go up and you look only at wealth, then there is that effect that affects the people who are in the higher wealth categories. On the other hand, just looking at wealth, 60% plus of the population owns houses, and house prices have gone up quite a bit as well. So there's a bit of an offset there on the wealth side. But the most important thing, I think, is this, is that what's the best way to help the average guy in a bad recession? It's to get the labor market working again and to get jobs. And what low interest rates have done, along with other policies, and again, not a panacea, but working in the right direction, what low interest rates have done has been, besides stabilizing prices, which of course is critical, it has helped support the recovery and help create jobs and put people back to work. There's nothing you can do better for income distribution than making the job market stronger, because that's where most people get the bulk of their income. So the stronger the job market, the broader the benefits. And so I think it's a kind of a mixed picture, frankly. But I would also finally, just to add, and here's one thing I agree with a lot of what was said this morning, is that relying on the Fed to take care of all these problems, income distribution, long-term growth, the fact that nationals are only in second place, all that, the Fed cannot do all those things. And so if people are concerned about these distributional issues, you know, we've got educational policy, we've got immigration policy, we've got training policy. There's lots of stuff that could be done in Washington to address these issues. You know, the Fed can't do it all. We're working with the tools we have. So I guess what I would just say is I agree very much with the argument that what we need is a much broader-based attack on these problems, and that, you know, the Fed is using the tools it has, but it can't solve all these problems by itself.
And that's a good place, I think, to go to a couple of questions from the audience. Please come up to the microphone, if you would, at this time, and we will take just a couple. Yes, sir.
Okay. Hi, I'm Hank Mulvihill. I operate the Fed Friday Forum. We've been analyzing and talking about these things since 2002, and I'm a Fed supporter. Thank you for all the work you've done. It's been spectacular. Thanks to the Bush Institute and the other panelists. Magnificent. I do have a question, and the question is, haven't productivity gains been so sufficient that that might be what's crushing the labor force participation rate? That's part of it. The second part is, doesn't that lead to, in fact, a continuation of the new monetary policy reality of activist central banks all over the world? Thank you.
So you have a very, raise a very interesting point. Let me tackle it from a slightly different direction, which is, it's been noted that the Fed has been over-optimistic in its forecasts about how quickly the economy's output would recover, about the growth rates. What is not often noted is that the Fed has been too pessimistic about how quickly the unemployment rate is going to come down. The unemployment rate has come down faster, consistently faster, than the Fed has predicted. Now, what does that got to do with the question? What it has to do with is the relationship between output and workers, that's productivity. And productivity gains have been relatively modest in this recovery. And because they've been modest, the relatively weak gains in output have been sufficient to lower the unemployment rate pretty significantly. At the same time, though, weak gains in productivity mean that real wages aren't doing much. And so real wages have been very flat, labor market's been weak. So that's probably one of the reasons. And of course, one of the big questions we have right now is how much slack is there still in the labor market? How much more capacity do we have in terms of unused workers that could help increase output in the economy? The unemployment rate is coming down. Does that mean we're almost at full employment? Well, the labor participation rate has fallen a lot as well. Some of that is just because people are getting older, retiring, et cetera, but some of it may be simply that with productivity being weak, wages being low, opportunities being restricted, a lot of people have decided that for the time being, they're going to sit it out. And one of the possibilities, and we're curious to see how this works its way out, is that as the economy strengthens, as labor markets strengthen, maybe some of these folks are going to come back in. But you put your finger on the productivity issue as being very central to virtually all that we've been talking about. For example, the greater productivity, the more easily the government will be able to pay for these long-term entitlement obligations, because they'll have more growth and more tax revenue. So productivity is crucial. Productivity is not something the Fed can do much about, if anything. It has to do with technology, it has to do with education, it has to do with capital investment, taxes, a whole variety of programs. So once again, I come back to the agreement with the point that we need a much broader-based set of policies to attack, all the problems that we face.
Yes, ma'am.
Yes. Kathleen Cooper with the Tower Center for Political Studies here at SMU. My question, Dr. Bernanke, is how you have reacted over the last couple of years to what has happened to some of the banks that at your time of need, at the country's time of need, the economy's time of need, decided to take on some of these institutions. I'm thinking, I guess the best example is Bank of America, who came forward for Countrywide and for Merrill Lynch. Mm-hmm. And in the last couple of years, the government has gone after them, and they've had paid some very large fines. We hear about that a lot. Anyway, I just wondered, obviously they did it at the time for reasons that they thought would be good for their institution for the long term. But as you look at the effects that it might have at a future time, I'd be interested in your reaction. Thank you.
Well, as you say, Bank of America, for example, made those two purchases based on calculations of the benefits to themselves as a company. There was certainly no pressure on Bank of America to buy Countrywide. With respect to Merrill Lynch, there was some determined conversations with John Thain saying you should try to find a buyer if you can, and of course Thain went to Ken Lewis. So some of those purchases came with some very bad mortgages and some very bad assets, and those are being worked out. And I guess the Fed is not an enforcement agency. The Fed, this is coming mostly from the Department of Justice, et cetera, and they're making judgments about the legitimacy, legality, et cetera, of some of these loans that were made, many of which, of course, were terrible loans. I note that many of the people who made the loans, of course, are long gone, and so what's really happening is that there's compensation being paid through fines. I don't really have, not being involved in these individual cases, I don't really have a strong sense of the fairness or unfairness. What I hope will soon happen is that we'll have worked through all of this, because, as you know, these bad loans are mostly disappearing now, and default rates are coming way down. We're getting, I hope, to the end of these fines and these programs. I hope we're getting to the end of the putbacks and all these other things that are the residue of the crisis. Part of the reason why a financial crisis takes a long time to overcome. But as this ends, I hope going forward that a business will be returned to normal, and we will have all collectively learned some lessons from the crisis. But in terms of the legitimacy of these individual fines and so on, I guess it depends on the circumstances of the case. And I think that you can't, when a company acquires another company that has whatever liabilities it may have, as a legal matter, I don't think you can simply wipe out those liabilities. Otherwise, companies that were under legal challenge would just become acquired. So that's where we are.
With apology to several people queued up at the microphones, I'm gonna take the microphone back for two final quick questions.
Okay.
For you, Mr. Chairman. First of all, you're just 3 or 4 months out from your tenure as chairman, but that you've probably had some opportunity to reflect. What would you like the history books to say about your tenure as Fed chairman? What do you want the headline of your legacy to be?
Did the best he could under tough circumstances. I'm writing a book now. I'm trying to begin a book process, and I think more than just selling a book, I think I'm really interested in the personal therapy here. I really want to go back and think through all these decisions, and recognizing that many of them were made under very tight timelines, under very difficult circumstances. Try to understand, where we did the right thing, where we made mistakes. Try to really come to grips with all this. I think we did make a lot of progress. I think we made the system a lot more transparent. I think we did avoid the collapse of the financial system, which obviously would have been a terrible outcome. Were there mistakes? Absolutely. I'm going to try, in my own writing and thinking, to try to understand for myself, what they were. But I'm sure plenty of others already have opinions, and we've heard a few today.
I won't go any deeper into your therapy than that, and I'll go light on you for the last question, which will be about baseball, because we share season's tickets to the Washington Nationals. The chairman and I do. I know that he's one of the 2 savviest baseball aficionados to have served in government in this century. Well, all right, I'm getting the evil eye here. You're the second. You're the second savviest aficionado of baseball. Give us your predictions about the strongest teams likely to hit the playoffs. And second, because I've been sitting with you at several games this year, I've noticed that the Washington Nationals slugging right fielder Jason Worth always tips his cap to you when he heads into the dugout.
Well,
Explain why that is.
Let me take the fifth on the first one, and let me tell you the second one. So I had the opportunity to go to batting practice, for the Nationals, which is a lot of fun. My wife and I went and watched the players, they're hitting, fielding, and got to talk to a few players. Mike Rizzo, the general manager, took me around. He said, introduced me. Davey Johnson, the manager, this was last year. Davey Johnson said, Ben, I want you to meet Jason Worth, the right fielder for the Nationals. So he took me over to the dugout, and there was Jason, big, tall guy with hair down to his shoulders, And Davey says, Jason, this is Ben Bernanke. I want you to meet the chairman of the Federal Reserve. And Jason looks at me and says, you're the chairman of the Federal Reserve? And I said, yeah. He said, well, what's the deal with QE3 anyway? So ever since then, when he comes in, particularly if he's made a good play or something, he tips his hat.
It's absolutely true. He always tips his hat to Ben on his way in. And Mark, if that hasn't calmed you down, I'm not sure we're going to be able to calm you down about.
I see he's been on his phone the whole time.
Jason Worth spotted something that all of us know, Ben, and that is that you have been a spectacular public servant. You remain a superb educator, and we thank you for taking time with us this afternoon.
Thank you for inviting me.